Hi, I'm Adrian Manz. My wife Julie and I are full-time professional stock traders. We've worked from home in front of 8 computer screens trading large cap stocks on the U.S. exchanges every day for the past 15 years. We love what we do, and if you currently trade for a living or think that you'd like to try trading for a living, then I believe that learning my style of trading is one of the least risky and most profitable techniques there is, and I have 7 years of publicly documented results to back me up. Each of the spreadsheets that you're looking at chronicles what happened during a given year for my trading plan. As you can see, my style of trading is all about planning and control. My focus is on trading as a business, not a game, not gambling, a business. And just like any other successful business, this one is all about the careful execution of a meticulously crafted plan. When I say meticulously crafted, I mean it. Let's take a look at what I'm talking about before we go on. What you're looking at here is my around-the-horn trading service. This has been around since 1999 and has been available to Trader Insights customers since 2005. The first section here is where it all started. This is the around-the-horn trading plan, and it's based entirely on the ideas and discipline that I detailed in my first book, Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. As you can see, I leave nothing to the imagination when it comes to setting up a position. These plans are always published today for tomorrow. And when the market opens, this portion of the plan is still where I focus all of my attention. That's because I think the open is the most difficult time of the day to trade, so I like not having to think too much about what I'm doing. All the levels, the entry, the stop, the initial target, the 50% to target price, everything is clearly identified and plotted on my charts the night before. Then the next day, all I have to do is follow the rules at the back of every trading plan in the morning. I enter at the entry price. If price moves to the stop, I exit for a loss. When price gets the 50% to target level, I move the stop to the entry price. When price gets 10 cents to the target, I move the stop to the 50% to target level to lock in a profit. When price moves to the target, I take off the position unless we're in a fast market and I get an extension. In that case, I use the target as a trailing stop and progressively ratchet in behind the extension. Essentially, what's important here is to see the level of planning that you should be doing for each and every trade. Over the years, Julie and I realized that stocks with a little less clear of a road to victory could still make for some very good trades. That's how the stocks to watch portion of the plan came to exist. The setups are good. They're true to the ideas in Around the Horn, but on the setup day I was unable to find a solid stop for the next day's trading. So the way we work with these trades is this. During the trading day, I look for the first pullback or consolidation on a 5-minute chart. If a violation of that pullback, when used as a stop loss, gives me better than a 1.25 to 1 reward to risk ratio, then I'll take the entry if it triggers. The rest of the trade is handled just like the Around the Horn trades. Then a couple years ago, a subscriber asked me if I ever look for fast trades or scalps on market momentum. I said yes. He asked if it was possible to put those together as candidates prior to the trading day, and that's how the radar section of the plan was born. These represent discretionary setups that grab small profits on fast moves. I'll take these trades only on market and sector confirmation. Many subscribers and conference attendees have asked if I ever trade Nasdaq. I always said that for various reasons I had traded only on the New York Stock Exchange since 2002. Now in 2011, someone in the audience at the Traders Expo asked me if I was still focusing solely on the NYSE. This time the answer was a little different. You see, with the advent of electronic trading on the big board, its personality changed a little bit. Profit targets were narrowing significantly, and I found myself taking more and more trades on the NAS. Of course, the next question was, would you consider publishing those setups? That conversation took place in May of 2011. By September of 2011, I was testing my ideas. By December, I was sharing them with a few friends, and in March of 2012, I launched a new trading service that focused strictly on Nasdaq scalp setups. It's evolved a bit over the year, and today it looks like this. There are usually about 6 stocks on the plan, and each has about 3 entry points and targets. These are based on the previous session's price activity, volume, block trade activity, and general signs of institutional activity at various price levels. I take these trades after the first 5 minutes of trading have passed, and the results have been great. Later in this video, I'll show you examples from the plan and how they played out in November of 2012. By now you should get the picture. I'm pushing the idea of planning and journaling all of your trades because I believe that it's the only way that you can ever hope to make a living in this business. You have to know what you're going to do, why you're going to do it, what to do if things go right, what to do if things go wrong, and how to objectively evaluate your results. When I say objectively, I mean that too. Let's return to the spreadsheets I flipped through earlier, and let's look at a single month instead of yearly activity. I want to show you what information I think you should be keeping track of so that you can accurately gauge what's going on with your trading. Now these are from October of 2012, and they are for the around the horn portion of my trading plan only. But look here. I know exactly which patterns triggered. If you're familiar with my work, then you know that around the horn was written around a baseball analogy, and I named the patterns after baseball plays so that it would be easier to visualize. So for example, fastball refers to an expansion of range and volume setup. It's named after the most powerful pitch in baseball, and I think it's the most powerful type of move in trading. Most of you have probably read around the horn by now, so I don't really want to focus on the patterns here. What I want you to see is what I am journaling in these spreadsheets. Notice that I can look back on any given month and evaluate how many times each pattern presented itself and how often each one triggered an entry. I can also assess the profitability of each pattern, my ratio of longs to shorts, my ratio of long to short profitability, and whether or not I'm allowing a pattern bias to influence my planning. Now, an active trader who develops a profitable trading strategy and treats what he's doing like this, treats it like a business, can realistically generate a return averaging close to 5% a month. It takes hard work, laser-sharp focus, and lots of practice, but with focus and dedication, I believe it can be done. Of course, there is a risk of loss in trading, and you should never trade with money you cannot afford to lose. Trading isn't for everyone, and you should always consider your own unique situation prior to making investment decisions. You should also carefully consider the claims being made by advertisers who are marketing trader education and tools. Ask yourself whether it sounds like they're selling reality. Is it realistic, for example, to expect 1,000% returns from a trading program that someone's marketing for $1,000? Now that said, my trading plans have produced publicly documented positive results month over month for 7 years. Since I started publishing my trading plan in 2005, I've consistently chosen stocks that yield profits. While we certainly have had losing days and even losing weeks, my plans have not generated a losing month in the past 7 years. My trading plans have posted monthly results as high as 11% and an average annual return of 45%. Those are not get-rich-overnight results, but they are great business results and can be increased with the responsible use of leverage. Initially, I never advocate using leverage because while it can increase profits, it can also significantly increase risk. Once a trader is comfortable and consistently profitable with a system, however, the use of margin to leverage results is a core part of business planning. Trading is different than investing. As an equities trader, you need to be able to profit whenever a market makes a trending move. That means profiting when things are moving higher and when they move lower. One of the things that gives my trading plans an edge is that I'm not just trying to figure out what I can buy next. If markets are showing signs of reversal moves lower, I'm going to plan to short the high flyers, and this gives me the potential for outsized profits. They fall faster than they climb, and as a trader, I need to be ready to capitalize on the implosions when they occur. When the market blew up in 2008, my plans generated huge gains because I correctly spotted the signs of the impending collapse and showed my subscribers how to capitalize on the mayhem. It's important to understand that participating in the equities markets and maintaining a record of profitability usually requires activity on both the long and short side of trading. Stocks usually unwind gains much faster than they create them, so short sale moves can actually make up a majority of intraday profitability. Now here's another important point. My record over the past 7 years is comprised of stock picks published the night before the trading day. These are not back-tested results that had the benefit of hindsight, and every plan is published and time-stamped on a commercial server at an internet service provider. These are the results of a plan that is always posted tonight for trading tomorrow. The significance of this is that the results can be evaluated objectively, and that separates my trading plans from almost everything else being offered anywhere at any price. Trading systems that are based on computer-generated models that use historical backtesting to validate results are often tweaked to the point that the only way they'll ever work again is with the assistance of a time machine. Anyone can generate 1,000% return with the benefit of hindsight and curve-fit results. The trick in trading is to generate positive results in a proactive, actionable format, and that's what my trading plans are designed to do. What I want to talk about in a few minutes is that new strategy, the one that I've been working with since 2012. It uses the same logic as the service that I've been publishing since 2005, but opens it up to an entirely new audience. The strategy generates more potential trading opportunities and more potential profits for traders who actively monitor the markets in real time during the trading day. Before I get into the strategy, though, let me tell you a little bit about myself. After finishing my undergraduate degree, I completed a master's degree in clinical psychology and then a joint MBA-PhD program in international business and finance and organizational behavior at the Claremont Graduate University. While I was at Claremont, I became good friends with my professor Peter Drucker. He's a business management legend, and he convinced me that there was a correct and disciplined way to approach any business, and what I learned from him has applied to everything I've done since. I also met my future wife and business partner Julie at Claremont. Julie and I began talking about using statistics and behavioral models to interpret and predict market behavior. If you take a close look at what happens every day, you'll see that the markets are actually just pushed and pulled through the phases of the liquidity cycle by rational actors. Rational actors is a fancy way of saying human beings who are looking to maximize their self-interest. They are behaving in a manner that is predictable, and capitalizing on that predictability is what allows some of us to predict what may happen next in the market with a fair amount of certainty. You can use statistics and sophisticated computer models to identify which phase of the cycle we're in, but I've always found that it's really much easier to look at daily and intraday charts and let them tell me how the rational, or sometimes not so rational, actors are behaving. For example, is the market in an expansion of range and volume phase, or is it range-bound or showing signs of an exhaustion reversal in the making? Each of these phases is created by the emotions and actions of people. There's actually an entire discipline within psychology and economics called behavioral finance that seeks to predict behavior in the markets based on known characteristics of how humans are wired. For me, it really boils down to this. Markets function because of decisions put in place by people, and when people make decisions in response to threats or opportunities related to their own self-interest, they tend to behave predictably. Julie and I started our company with the intent of capitalizing on behavioral finance constructs in our own trading. Learning to trade successfully was a byproduct of researching behavioral finance and trying to figure out what drives human behavior in the markets. Ultimately, we came to the realization that everyone overcomplicates trading. As we began trading for clients, we couldn't help but notice how the same trading patterns kept repeating themselves over and over again. Day after day, we would watch the exact same scenarios play out. We were and are fascinated students of the markets. We read everything we could get our hands on, and a few years later, I wrote 2 best-selling books on the markets myself. I speak regularly at the Money Show, Traders Expos, international trading conferences and events, and you can read about me in magazines like Traders, Active Trader, and Technical Analysis of Stocks and Commodities. I love the markets, and I'll take any opportunity I can get to share my ideas and focus aspiring traders on what can really work. In a nutshell, what I tell traders in my books and seminars is to take a back-to-basics approach focusing on chart and tape reading. A chart of price, time, and volume is all that is needed to interpret what's happening in the market. And if you can get proficient at interpreting what you're looking at, then acting on the information in front of you is all it takes to start navigating the markets like an insider rather than a gambler. If a market is collapsing, is it doing so from a price level that previously caused the collapse? If so, the market is telling us something. If a market is rocketing higher, is it doing so from a price level that previously led to a move higher? If so, the market is telling us something. I believe past behavior is actually the best predictor of future behavior, and I think the only indicator you really need to interpret price behavior is a chart of price and volume as it plays out over time. This has been my sole focus for nearly 15 years. The push and pull, the psychology of market participants at work, it's the only thing that matters. Nothing else that I could consider would add any further clarity to my understanding of what's happening. Not very many people trade this way, and my focus on simplicity has brought me a lot of attention over the years. As I said earlier, you'll definitely notice that I'm a very frequent public speaker when it comes to the subject of trading. And whether I'm on the radio, television, internet, or live at one of the many national and international conferences I speak at, I never feel like I can get enough opportunities to talk about what we do. I love a lot of things about this business. Traveling and speaking to other traders is definitely one of my passions, and the fact that I can turn these trips into working vacations for my family and myself makes trading for a living that much more attractive as a business in my life. I fly all over the world with my family to show other traders how to do what we do, and wherever we land, whether it's New York, London, Paris, Munich, Rome, or Vienna, I can earn my living on my laptop while at the same time enjoying the opportunity to make a public presentation and then having a great vacation with the people I love. The best part, no matter where I am, I can control my income and risk by adjusting share size and leverage. This lets me adapt to the current market environment and maximize my earning potential when the climate is just right for big gains. Of course, past performance is no guarantee of future results, and the use of leverage to produce large gains can also cause similarly larger losses, but I believe my methodology has been proven to be successful in the past. At some point in their career, most traders focus in on mechanical or mathematical patterns without regard for the human psychology that these patterns actually represent. They believe that by letting the computer do the thinking, they can avoid losing money and be on the right side of the trade more often than their non-mechanical counterparts. What I discovered is that the holy grail of trading is to keep your focus on the players, on what real people are actually doing in a market while keeping risk to a minimum. One of the things that I learned about being a successful trader was that being able to take moderate profits consistently was far more important than swinging for the fences. Successful trading is a game of hitting singles, not constantly trying to knock one out of the park. This attitude allows me the potential to make profits regardless of the current market situation. I'm able to consistently find sectors that are in motion, and then to find opportunities in stocks within those sectors. I look for the psychology playing out, and then locate the shortest distance between a logical entry point and a logical profit target based on the probable actions of the rational actors I spoke of earlier. Compare the logic behind what I'm doing with what most traders are trying to profit from. They pick a stock like Microsoft, Amazon, Baidu, or Cisco and decide this is going to be the only thing they trade. Things go all right for a while, and then when an accumulation or distribution range hits the stock, they totally bomb, losing most or all of their profits. That wasn't for me. I wanted a trading strategy that had the potential to find profitable trading opportunities all year round, one that could work in almost any market, up, down, or sideways. Julie and I discovered that by focusing on 8 chart patterns that represent 8 possible behavioral reactions, we had the ability to make consistent profits on the predictable movements that stocks made throughout the day. For years, we traded this strategy only on the New York Stock Exchange. That was because the NYSE was a place where a single individual, known as the specialist, was responsible for all the trading in a single stock. This gave us the ability to anticipate the specialist's psychology and to adjust our trading accordingly. Things have changed over the years, and the New York Stock Exchange, while still a very different market than the Nasdaq, now shares many of the electronic trading characteristics that the Nasdaq has had for many years. Today, only large orders are handled by the specialist. Smaller orders are routed through ECNs, with the result being that intraday swings and profit potential have become more constricted, and our approach to the markets has been adjusted accordingly. As the two markets became more and more similar, we came to realize that the around-the-horn methodology was now equally viable in the Nasdaq as it had been for so many years on the New York. The approach is slightly different, the profit target slightly smaller, but the potential for profit overall is dramatic. So back to the scalping strategy. The way we work with my Nasdaq strategy is this. Every night, I personally review 1,000 or so stocks on the Nasdaq that trade between $15 and $120 per share. I'm looking for stocks that have averaged between 500,000 and 12 million shares a day over the past 30 days or so. I also look for stocks that are trending and presenting one of my 8 patterns. My final step is to create a trading plan for the next day, which I'll follow exactly. I identify the handful of stocks I'll try to trade if and only if certain entry criteria are met, and I stick to those trading plans without fail. You'll notice when you look at the scalper setups that you can find in the resource menu that for the most part every setup has 3 different entries and 3 targets. Those are based on the logic I spoke about earlier and incorporate major market inflections, pivot points, institutional buy or sell areas, natural support and resistance, Fibonacci retracement zones, and volume weighted average price reversal points. I probably left something out, but what I'm trying to convey here is that there's a lot of things you need to look at every day, and it's almost impossible to do it on the fly during the trading session. You really need to spend a few hours after the close putting together all the pieces and figuring out exactly what you'll do tomorrow and why. With a great plan in your hand, you don't have to worry or second-guess your decisions intraday. You show up in the morning, you wait for the opportunities, take the trades, and tomorrow you do it all over again. I take the stocks on my trading plan. I plot them on one of my computer monitors before the trading day. Then I draw lines representing each of my possible entries and profit objectives on those charts. The process of laying out the charts and drawing the lines takes about 20 minutes each night. The following day, I just take the trades based on a violation of each of the lines. It's really that simple. I never deviate from the trading plan, and this takes the uncertainty out of the trading day and allows me to replace it with courage and impartiality. Remember, we're simply trying to skim off a moderate profit from these intraday trades based on the patterns that we've seen repeat themselves over and over again. At the end of the day, we cash out of all of our positions, hopefully taking profits with us. We're not looking to be right all the time. We're not trying to correctly predict big-picture market dynamics. We're working as traders in a market defined by human psychology. And being a good trader is all about impartiality and intuition. You can only get there when you allow yourself the emotional flexibility that comes with not being forced to be riveted to a computer screen and making decisions on the fly all day long. There are just too many factors to consider intraday to work without a plan. I said earlier that we would look at how a few of these trades played out. Here are 3 examples from November when we were putting this video together, and these are from a single trading day, and I think they illustrate just how easy it is to recognize the good opportunities and separate them from the not so good opportunities once you have a plan in front of you. Now, if you'd like to see videos of these entries and exits developing on a 3-minute chart, then go to the resources link on this page or at traderinsight.com, look for the real-time trading files, and select the appropriate link, and you'll see much longer videos of each one of the trades. Now, the first one that I want to consider is GTLS. That's Chart Industries Incorporated. This was an expansion of range and volume short side setup. The first planned entry on this one is a short sale at $59.19 with a $58.76 target. That price is very close to where the stock closed trading the previous session, so it's very likely that that one may trigger. Now, the next entry, Alt 1, is at $59.66, and the short sale target on that one, $59.30. So it's up a little higher into the previous session's range, and it overlaps with a bunch of that volume-weighted average price activity, institutional activity, all the stuff we talked about earlier. And then finally, we've got Alt Entry 2 at $60.04 with a short sale target at $59.74. So even further up into the range, and what you see there is you've got 3 opportunities over the course of the session for entries, and then you also have the pivot lines set up on the side so that we know exactly where the likely inflections are going to be, and we also see where we can sort of get a better entry based on some of that floor trader pivot activity that goes on during the session. Now let's take a look at what happened when GTLS started trading. So as you can tell, I'm very rule-based in how I apply this stuff. I do use discretion in my trading, but I like to really stick to a set of rules. The first thing that you should notice is that when the stock opened, it traveled higher. Those blue lines are targets, and the red lines are entries. I sort of changed the format here a little bit to make it easier to see what's going on. And we see here that right around 11:15 New York time in the morning, the stock went up and almost got above that $59.66 entry price. And, you know, that would have been great if it had popped through there. I would have been looking to take a short side entry on that, but it didn't get through. And, you know, close is not really close enough for me. I like to see things develop exactly the way that I want them to. So in this case, what did develop was a move down through that $59.19 entry on the trading plan. And that was a solid move lower. We see that you know, the stock had moved sharply higher and then had a sharp reversal lower, and that the ensuing move then carried it all the way down to that $58.76 profit target. People always want to know, what'd you miss? What didn't you get on this one? So I'll show you. We did see an extension of price to the downside, but my plan is always to try to capture as much of each one of those individual moves as I can get. If it doesn't blast right through a level, so when it got to $58.76, the fact that it didn't go and just really just push down through that hard, it bounced around there on that support and resistance from the previous session for quite some time, and I had no way of knowing at the time that I was going to see a continued thrust to the downside. So I don't mind missing the rest of the trade. This is all about hitting singles. This is all about getting on base. And, you know, in this case, we're going to see that GTLS does make an extension, and it's one of those situations where you don't get every dime out of a trade that you can. But as I said earlier, it's been my experience over the past 15 years that the market likes to take it away a lot more than it likes to give it. So I like to take profits off the table as per the trading plan and not worry too much about what happens afterwards. The next one of the 3 stocks that triggered on November 27th that I want to talk about is unique not for what it did, but rather for what it didn't do. So I want to talk about a trade that I didn't take, regardless of what the outcome was, and why I wasn't interested in it. But first, let's look at the setup. It's in Copart Incorporated, ticker symbol CPRT. It's another expansion of range and volume short setup. The entry this time was $29.95. with a primary target at $29.75, so that was expected to be right off that previous session's range, with an alternate short entry at $30.07 and a $29.88 target, and then an alternate 2 entry at $30.22 with a target at $30.03. So this had very, very tight parameters to begin with, and then once trading opened, it did a couple things that I generally don't like to see, and I'll only take a trade that develops the way that Copart did if I see very strong market and sector confirmation. So let's take a look at how this one played out. When it opened for trading, CPRT gapped right up to that primary entry. And while there's nothing wrong with that, And I certainly would have considered an entry in the stock had the next bar reversed and plummeted lower through that 29.95 level. What we see happen instead is that the stock shot higher all the way up to 30.21 and then made a move back down through the secondary entry. Now, as I said, I don't like to take these in the first 5 minutes of trading anyways, so I'm always waiting for a second bar to form, and in this case we're on 3-minute charts, so the second bar almost has to be done before I'll consider taking a trade. The third bar on the chart gets up through the central pivot, but doesn't really form that pattern that we just saw in GTLS. So we didn't have that sharp move higher followed by a sharp move lower. We just had one bar that tried to get up and above the pivot and then right back down into what became a consolidation range. Consolidation ranges can make for good trading, but in the case of a stock that gapped like this and then immediately leveled off into a consolidation range, I really want to see signs of weakness in the broader markets before I'll consider taking a trade. When CPRT hit the trigger price, the markets were actually traveling higher. So given the facts that I had a gap opening, followed by a consolidation, and then a trigger that did not occur with a sharp contra-trend spike and a reversal, that kings and queens kind of a top that we talked about earlier, I'm left questioning whether or not I've got a solid entry or if I've got a stock that's just consolidating right around its gap range and then is going to turn around and travel higher. In a case like this, I'll wait to see if the market reverses. If the market starts heading lower in the direction of the planned entry on the stock, and the stock is trading above a planned entry price and then travels lower, I'll take an entry. Otherwise, if it goes to the profit target, it's probably going to do it without me. Now, I will tell you that over the course of the session, what CPRT wound up doing was traveling sideways in several consolidation ranges, and then into the close of trading, making a move lower right down to that profit target. But on something like this, where the parameters were as tight as they were, a 20-cent target on each one of the short legs, I would prefer not to be in a trade all day long, dealing with consolidation after consolidation, and that's most likely what's going to happen when we get a gap right into a pivot that seems to hold up the way that this one did. And from the same trading day, let's take a look at one more. This is Bed Bath & Beyond Incorporated, ticker symbol BBBY. The primary entry on this one, 58.93, with a target at 58.66. The Alt 1 entry, 59.21, with a 59.01 target. And the Alt 2 entry, 59.51, with a 59.17 target. Also, notice those pivot lines over on the right side of the plan there. We are going to keep an eye on those as trading develops and see how they impact the behavior of the stock. Once again, we see that the stock is in a consolidation range. Now, I'm not really crazy about it ever, but BBBY is a much better consolidation as far as I'm concerned than the last one that we looked at, because in this case we saw a move from a flat open that got us through some pretty high volume bars and then pushed to the upside and consolidated right around the central pivot. Now, the entry point for this is just above that central pivot line. So the primary entry, 59.21, with a shallow target again down at 59.01, is going to require that we get a pop up above our entry line and then a sharp reversal lower. So in this case, I'm not as worried about the fact that I'm in a consolidation as I was on CPRT, but I'm still going to require that it perform very precisely in accordance with the rules of the plan before I even consider taking a trade. A few minutes later now, and we see that a trigger has happened. We've had a trigger event. The stock did pop higher, pop lower, got that kings and queens type of reversal, and down through the pivot line. Now, this is sort of the low area of where the consolidation happened before. Right at this point, I'm just hoping history doesn't repeat itself. Hope it doesn't just congest and start moving sideways. But initially anyway, gonna keep that profit target right at 59.01. If it hits there and it doesn't just jam through it, I am going to take the trade off at 59.01 or as close to it as I possibly can. And if it gets down to 58.93, I'll just take another position, because that's what I plan to do, and intraday I really don't like to second guess these entries. 3 minutes later, price hit the 59.01 target, backed off, closed out this position, and am looking for a 58.93 trigger. If that happens, I'll take another position and I'll look to short the stock at 58.93 and shoot for the next level of support and resistance that was identified on the around the horn Nasdaq scalper plan, and we should know in just a few minutes whether or not that's going to happen. Nothing much happened with Bed Bath & Beyond later in the session. It formed another consolidation range, popped higher, popped lower, didn't have to endure any of those swings because we were already out and ready to take another entry if the opportunity presented itself. So I hope you saw from these examples and from the others in this video just how powerful a good trading plan can be in developing and structuring a profitable trading business. As I mentioned earlier, I am making this trading plan available to a wider group of subscribers. And if you'd like to take a look and see if you can learn how to trade this way, I'd like to tell you about a very special offer available only from TraderInsight.com. The price of my trading service is normally $1,997 per year. And as you'll see when you look at the rest of the videos in this presentation, that $1,997 buys you a trading plan that's very easy to implement and one that can potentially generate a lot of profitability. Now, to get some committed traders on board and fill my inner circle with people who are really interested in trading for a living, we're offering a discount that takes the price down to $997 per year. That's a $1,000 savings. What's more, the offer is risk-free. If at any time during the first 60 days of your membership you decide that my around-the-horn Nasdaq scalp strategy is not for you, just let me know, and I'll refund your money, no hassles, no questions asked. Your $997 membership will get you a new trading plan every day of the week and put you in front of the opportunities that represent the very best scalp trades I can find. You should also know that during your membership, I'll be providing training. At first, I'll show you how to find the easiest to execute setups. Once you're confident in your ability to find and execute those, we'll move on to the next layer of setup. They're just a little bit more difficult to find, but once you can make yourself aware of all the factors and contingencies that you need to look at, they make for really good setups as well. So over the course of a year, I'm going to do a lot more than provide you with a service that you can trade from. I'm going to try to teach you to trade, teach you the rationale behind the setups, and what differentiates a good intraday trigger from one that has less potential. If you'd like to try the service risk-free for 60 days, click on the link in the About box below or visit TraderInsight.com/ATHNAS, all in caps, so TraderInsight.com/all caps ATHNAS for more information.